Good afternoon, LinkedIn community. Great to have you back here for another Philanthropy Friday. I'm Mark Halpern. I'm the CEO of WealthInsurance.com. I've got a great guest today, great subject matter, and it must be a great subject matter because we had about 220 people register for today's session, which is great. And we're so excited to be able to help to spread wisdom and knowledge, not only to professional advisors who are really the gatekeepers to their clients and the clients' advice that they get, but also to all the charities in Canada, of which there are 86,000. And a huge part of the GDP comes through the charitable sector as well, who are connected to all these amazing donors who are collecting somewhere around $12 billion a year for the important causes that Canada cares about. And if we don't have the wisdom and information that we need to be able to help those clients of ours and the charities and the donors, then I think we're missing out on a huge opportunity and obviously a big responsibility as well too. So just a little bit of background. I've been a professional advisor for 32 years, and we work in three different areas. One is in estate planning, making sure that people's financial architecture and financial furniture line up with today's reality. Second area we specialize in is tax minimization strategies using tax exempt life insurance, which we specialize in. And then the third area is philanthropy, which is really helping people create legacies or going from what we call success to significance, often just by converting taxes into charity. And we're going to be talking about that today. And that's really what a lot of our Philanthropy Friday is all about. I happen to sit on many advisory boards and get involved with a lot of donors as a legacy process consultant. And hopefully today we'll share some of those stories with you and actually be able to help you to assist the people that are important in your lives. What I'm going to do right now, I'm very proud and honored to have with us today my dear friend Jim Ruta of Advisor Craft. Jim and I go back many, many years. I mean, I think anybody in the insurance industry knows that life insurance started about, I think, in the 1800s. I think Jim started around then too.
Similar.
Similar, yeah,
Close.
certainly.
Close.
But certainly, Jim is a household name in the insurance industry as an amazing tactical coach, advisor, counselor to very many successful advisors. And I'm fortunate and grateful to call him my partner as well, because we came together a few years ago to create some masterclass programs for advisors utilizing Zoom, which really came into vogue obviously with COVID, and then created some platinum groups, and then created the Power of Platinum, which we're very, very proud to say that we've had, close to 200 advisors sort of go through and are very excited to help people introduce or incorporate strategic philanthropy into their clients' estate planning. And Jim, I want to welcome you and thank you for joining us. And maybe you just want to introduce yourself and tell us a little bit about you.
Hey, Mark, thank you very much. It's a delight to be with you. Always is. And yeah, we do go back more than 20 years, you and I, but again, really closely over the last 3.5 years when when COVID first hit and we sort of got together to help advisors be more, help more, and sell more. I've been in and around the business since 1977. Had a major corporate role up until the end of the 1900s into 1998. And then went on as a coach, consultant, and speaker and author. And so I've written a few books, and I do a lot of work around the world. I'll be speaking in Las Vegas coming up in about 10 days, and then after that, Beirut, Lebanon, and then I'll be in Warsaw, Poland, and then we have plans for South Korea and Hungary in the new year. So things look very good, and it's a delight to be with you. Recognized name in the philanthropy business. Nobody really better at this than you are, Mark. So it's a delight to be with you here today and help share some of your great ideas. Mark?
Fantastic, Jim. Thank you so much. And wow, that's a lot of travel. And fortunately, it doesn't really matter where you are anymore. You can do business anywhere in the world. I do want to just let people know that Jim heard me speak at a conference I was asked to speak at for an MGA 20 years ago. And unbeknownst to me, Jim was actually in the audience. And after I finished speaking, he sent me a personalized card saying, "Mark, you were great. One day you're going to speak at the $1 Million Round Table, and and I was just like, yeah, wow, Jim was there. Anyway, fortunately, I took that to heart, and I did speak at MDRT, and I did speak at the top of the table. So, Jim, you've been a great cheerleader, but a great partner to help advisors as well. So thanks very much.
You bet.
Good. So today, what we want to do is we want to get started by just explaining like why we're here and what we're doing. And Jim and I are going to sort of share some dialogue back and forth. I'm going to ask Jim some questions. He's going to ask me some questions, and hopefully we'll all come away with some very practical information that we can apply to our businesses right away. In terms of sort of, I put a little deck together, but I would suggest that we're really in very special times. If you look at this, there's a lot of negativity in the world, and people look at this as, wow, taxes, politics, differences between people. It doesn't seem like a very good environment to get things done. But if we just add a couple of spaces, we'll see that opportunity is not nowhere. Opportunity is now here. And as advisors, we're looking for ways to get in front of people on a favorable basis to help them. And often the area of life insurance is something that's very misunderstood. If anything, if you get into the high net worth market, often high net worth individuals look at insurance as a grudge purchase, like their car or their house insurance. They don't really understand what it does. They've kind of think of it as something they had when they had a mortgage and kids' education to fund and paying for food and whatever, and they've no longer in that category, but they carry around that what I call baggage with them. So what they don't understand is that insurance can be used as an incredible tool to create transformational change. And that's really what we want to focus on today and talk about some of those opportunities, and at the same time provide everybody who's on the call with an understanding of our Power of Platinum program, which is a mentoring coaching program that Jim and I created, and to help people who are interested transition to get even more information as we go along. Jim, you always talk about uh, you know defining yourself or making yourself different or standing out from other advisors, right, Jim?
Yeah, there's no question, Mark, and like that's exactly what you have done with and under two or three iterations over the 32 years you've been an advisor. And of course the last one here with respect to philanthropy is how again, you talk a lot about that leading edge of the wedge. I talk about that as a lead story. This is a way to get into the right places in the right way under favorable circumstances. And you have been an expert, and you are you're unbelievable with respect to how you can get in the door. And I want to relate to something a minute ago. You said, talking about people have a lot of baggage about insurance, and I know you'll talk more about this. And you think the ultra high net worth or the high net worth would all have this figured out, but as you point out all the time, it's not the case. And there's this difference between the civilian use of life insurance and the professional use of life insurance. And I think that's a real big part of it. And differentiating yourself in the market is key today if you want to get past the noise. And in our program in Power of Platinum, you'll provide all kinds of leading edge like leading edge of the wedge stories. And then we try to translate those into ways to get into all sorts of different markets. I was just on the phone on a Zoom call just before I came in here with one of our members from Western Canada. Exactly the same thing, not same idea, but not in the same market. But it still works. So this idea of yours, and I hope you'll talk more about it, leading edge of the wedge stuff, folks, if you're paying attention, this is how you can get in almost anywhere. Mark?
Fantastic. Well, I think maybe what we have to do is just set this up to sort of look at what's the landscape, what's the reality today, and where does philanthropy and insurance in particular sort of come together. And that is, we know that taxes are going up. It's not a question of if, it's a question of when. We have the AMT, the alternative minimum tax, which hopefully we'll get a chance to speak about in today's session. So you're going to see possible inheritance tax, wealth tax, taxes on principal residences. I mean, the government needs money. They're going to have to find it. And we're right now in a very heavily taxed position.
Hey, no, Mark, if I can, just to say, because you mentioned AMT, the alternative minimum tax, and I think this is something you talked about in Platinum too. It's funny, there's not a lot of room to go up from 53.53% in Ontario. There's just not a lot of room there, but they'll find sneaky ways of making that apply to more of your income and to more of your gains. And I think that's really the key, and why what you talk about all the time is so very important, Mark.
Beautiful. Well, hopefully there's still some time till January 1st, 2024 to kind of ring in some of those complications, which we'll get to. But to add complication, I used to think I'd knock on the door of a very successful individual and I think, how can I help this person? He probably has the best accountant, the best lawyer, the best insurance person, the best investment. And like, who am I? And I found out it's not true. I'm going to suggest 85% of the time people don't have their planning up to date. They're so busy looking after everything and everyone else. When it comes to themselves, they don't have up to date wills. They don't have powers of attorney in place. They don't have any tax planning. They don't have proper insurance. It's a mess. So that's another issue that people are really getting sensitive to. We have to do planning. The third area is there's a big risk here for charities. If the charities are not talking to their major donors about planned legacy giving, they run the risk of losing out on huge bequests, on huge donations of insurance policies, on huge donations of just charitable donations. And then, of course, our clients have a big risk of their legacy. They may have become very successful, but they haven't actually done anything transformational. And again, you don't have to be Bill Gates or Warren Buffett to be a philanthropist, but you can and you should be going ahead and incorporating strategic philanthropy into every one of your clients' estate plan, as we'll see, for the proper reasons. The other thing is clients are looking for meaning, especially coming out of COVID. We're much more aware of our mortality and our incompletions, so they'd like to do something. And I can't get over how few professionals and wealthy individuals and families don't know about philanthropy and the use of it as an estate planning tool to convert taxes into charity. I've spoken to some of the largest national accounting firms and investment firms and with insurance people, and there's just not a lot of knowledge there. So if they're not getting it from those individuals, how are they going to get it? That's why this is so important, because really,
Mark,
we're the gatekeepers. We are the gatekeepers.
And Mark, I just want to make sure that for a lot of the people listening, I think this applies to charities and to advisors that are looking at this. You say it's not just the uber wealthy. It's not just the people with millions of dollars to give away or to buy insurance or to do whatever they're doing to create those legacies. This stuff is really quite scalable down to surely the mass affluent marketplace. And so if you're saying, well, I'm not going to be doing Mark Halperin stuff with Mark Halperin's clientele, that's okay. You don't have to be in Mark's market to be able to profit from what Mark does in his market. And that's a really important part. That's a lot of what we do in Power of Platinum is to help you scale that so it fits your market.
Such a good point, Jim. And yeah, again, we're trying to create the north on the compass. And by the way, I have lots of norths on my compass as well of other advisors, but create a north on the compass. So at least that there's a direction to go in. And obviously getting there, you can get there by bus, you can get there by train, you can get there by commercial plane, you can get there by private plane. That's kind of the job of the coaching, to help people get.
Hey, you know what? And I got to just say, I just see Gordon Wusick has that. And Gordon, how are you? They're talking about philanthropy is reverse compounding that many don't understand. Wow, what a great line from Gordon West. God bless you, brother.
Very good. Thank you for bringing that up. I just remembered. I can't unfortunately see those comments. You can. So please, if anybody has any questions or comments that they would like to have addressed today, please put them in the comment section. And hopefully we'll have a chance to go through those. But just again, that's the reality. So what are we trying to do as an organization? We're on a mission, and our mission is really, we'd like to transform Canadian philanthropy by inspiring and educating professional advisors and charities and donors, as I said, to incorporate strategic philanthropy into estate planning, to obviously optimize people's wealth, or preserve their wealth, or leave a legacy. That's what I like to see Canada be responsible for. The second thing is, people know what insurance is, but they don't really understand properly what it can do. I think we need to do a much better job of that, and hopefully we're getting that way with these types of LinkedIn Lives, educating advisors, and also through Power of Platinum. But the more ambitious goal that we have is we'd like to create a national community of 100 professional allied advisors and charities that if each of us are creating $10 million a year and you have 100 of those, that's $1 billion a year. And that's not like, sort of cloud in the sky stuff. That's like crowdfunding, and it's possible. And we already have a couple of dozen already attached to that. And it's very exciting because we are the makers of change. And all we have to do is have the information in order to be able to help our clients. And there's no better way of doing it than by being an influencer. And I think that's really where we're at. And then just the last thing before our why, if you've ever read any of Simon Sinek's book, Find Your Why, the difference with the why, the how, and the what. Everyone has to have a why. That's what drives them passionately. My why is a Hebrew word called tzedakah, which is often mistranslated as charity. It actually means righteousness or justice. We have a moral and ethical obligation to give back if we've got. And there's always people who are in need. Over the last 2 years, we've created over $120 million of charity, which has been exceptional, but we've got a lot more to go. And if you haven't had a chance up until now, I did do a TED Talk back in 2019 at Moses Neimer's Idea City, and it's called The New Philanthropy. It was in the disruptors category. And I think it would be worthwhile to take a look at that because it'll certainly help frame some of what we're talking about today. Now,
Anybody, Mark, I can just say, if you want to watch that, you should watch that video. I think if you're a charity, I think it gives you interesting language to use with your clients because this is a words, stories, language, kind of questions business. There's no doubt about it, and that applies to charities too. We're trying to sell the concept to their clients, but also to advisors. You want some great language, and you want to hear some tremendous stories. Take the time. It's only 20 minutes or so that you can watch that great piece on Mark's website, and I absolutely recommend that to everyone.
Thank you, Jim. Look, I wish I could tell you that people call me and say, Mark, I'd like to give $20 million to this charity. Yes, it does happen. They say even a blind squirrel will find a nut once in a while, but it really has to come out of a process. So as an advisor, our clients need a team. They need to have a team of professionals, lawyer, accountant, investment, family office, insurance, and that people are working together to look at that client's big picture. So here are just some of the big picture things that we look after. And as you can see, it starts off at the top with very basic planning stuff. And we have to do all of this, but we always end up at the very end with charitable plan giving as a topic. And I think the key there is, charity begins at home. It always begins at home, but there are ways to move you the money that you might have to pay for taxes and create charity with that. And if you have a choice, is that something you'd be interested in? And I like to change the language, which is people think that when you give money to charity while you're alive or at death, you're disinheriting your children.
Mark, if I can just say something, that question has come up just now, and I think there's a couple people like that have just asked this question. So you are very timely here.
Oh, good.
Keep going.
Great. So the people have to understand it's not about disinheriting your children. Giving money in your estate plan is about adopting charity and disinheriting the tax department. So it's not about disinheriting your children. It's adopting charity and disinheriting the tax department. Now we're going to see again, the government needs money for taxes. There's no question about it. As a matter of fact, we there's a lot of taxes that people have, and here are just a sample of some of the things that people haven't done any crystallization to really say what are my final tax bills. But here in Ontario, you can just look at registered assets are going to be taxed at over 50%. So if you don't have a spouse to roll over to, obviously the taxes are due on the second to die. But if you're a single, widowed, or divorced person, that tax disposition could be very, very sudden. We also have capital gains taxes. Any growth in appreciated public securities or investment real estate or business, any of that growth, 27% of that growth, that win, is also going to be taxed. And then, of course, you've got corporate holdings. If you've got a holdco, an investco, retained earnings, shares, real estate, there could be a possible double taxation, bringing that total up to possibly 70%. And then you've got probate taxes. So at the end of the day, we have to help our clients understand that their $50 million that they feel very, very good about is only worth $35 million. And when they hear that, suddenly, besides getting a lot of not nice words that come out of, you know, little old ladies, little widowed women and men, they realize, oh, I didn't know that because nobody's told me about the tax. So once we have that information, now we could go ahead and do some planning to take some of that never spend money that they have that they might be being taxed on and use it to preserve their estate with insurance
Hey, you
or
know
with
what?
philanthropy.
Mark, I just want to pick up on a point that you sort of skipped by, but it's, I think, a very useful piece, both to charities and to advisors on the call and those listening and watching later on. This has to do with those people that are for whom this is really important. You said that tax could happen very suddenly, especially if you're single, divorced, or widowed. If there is nobody to leave the rest of your estate to on a sort of tax-free transfer basis, whatever those numbers might be, that those people are particularly good prospects for this sort of idea and for that charitable stuff, all that donation thing. So if you're looking for people to, where's the best places to go? I think, you talk about this all the time in Power of Platinum, that single, divorced, and widowed people, that's where this really can hit and hit hard.
Absolutely. And if as an advisor, I always look at it as it's kind of like a sandwich. There's the emotional conversation that you have, the discussion with your client. Then there's the technical or the more technical strategies. And then there's an emotional part at the end as well. So imagine, I think a couple of things that I think are, one is telling all of your clients that, each of us have three possible beneficiaries to our estate. You have family, you've got the government, and you've got charity. And each of us can only pick two. Which two would you like to pick? Well, most people would take family and charity. So with proper planning, you can be remembered for giving a lot of money to charity as opposed to writing a big check to the tax department. It might also be a time to ask your clients, if you could give away $1 million to charity, what charity would you give it to? And just be silent. Find out what's important to them. Is it the environment? Is it animals? Is it poverty? Is it education? And then help them understand that, if I could show you a way to give away $1 million to charity that would cost you pennies, or could actually be done even on a cash flow neutral basis, is that something that you'd be interested in? Get their buy-in, get them to understand that these opportunities truly do exist. And then that gives you permission to go back to them with strategies or things that might be of interest to them. Now, we talked about taxes. It's very important. We need taxes in Canada. So don't get me wrong. This is not about tax sheltering. You have to pay taxes, but there's no law that says that you've got to leave a tip. And since 1995, the government has created, I think, something like 25 different pieces of legislation to make it easier for Canadians to give to charity, where there's a benefit for the donor, because the government knows that it's not possible at all for them to be able to fund all of the social fabric that's necessary in Canada. Now, the AMT, which we're going to speak about hopefully shortly, that is going to have an impact, but it's going to have an impact at the very, very high end. As a matter of fact, of the $12 billion of money that goes to charity every year, about 35% of that money is made up of what we call transformational gifts. Transformational gifts are very big charitable donations of appreciated securities or money after somebody's had some sort of liquidity event. And that's really getting captured in this AMT, this alternative minimum tax. But it means that potentially 35% of that $12 billion could be affected, where people are not going to be necessarily as generous because there's going to be a tax now on some of those donations. So it's something to take into account. Now, what we want to do, all of us, is we want to create what we call accidental philanthropists or accidental philanthropy. Jim, we always talk about the fact that there are two types of people out there. There are people who give because it's just part of their DNA. learned about it through church, synagogue, their mosque, schooling. And then there are those people who don't. It just wasn't part of their education. When those people realize they have a choice where their taxes go, suddenly they become accidental philanthropists. And the people who are already giving can now give more for the same amount of cost, or give at the amount they wanted to give at less cost. So the stats still say that two-thirds of decisions to give to charity are driven by passion, people's passion for different organizations. Only 13% is driven by tax, Jim. Only 13%,
Yeah.
which means it's not the tax tail that's wagging the dog. It's the passion. So if you can find people's passion and then tie in the tax, how great can that be?
Yeah, I think it's really an important consideration for all of us as you look at this, is to say, you know what, it's that, and I think your diagram with respect to, there's three places, that your money can go when you're gone. If you can disinherit, the tax man for that part of it, or at least lots of it, then all of a sudden you're giving more to your family. And I know Marie Phillips has been asking this question all along, and she's also looking for short-circuited ways. I said not short-circuit's the right word, but resources to help make it easy to do some of these calculations. And I think you're going to get to some of that along the way. But again, this is to say that whether you're an accidental philanthropist or you believe in philanthropy, whether you want your name on the building or you don't want your name on the building, whether you're doing it as an example, whatever the story is, that there is a way to help all of those people, and all advisors and all charities can deal with some of these issues. Mark?
Beautiful. So so you're probably thinking, who are my clients that are possible accidental philanthropists? We started off, Jim, by identifying widows, divorcees, and singles right at the top of the list, that they are one incident away from a huge tax bill and they don't know that they have options. So really important to do the planning there. Anybody who's had a liquidity event, if they've sold their business or they've sold their investment real estate or appreciated securities, that's the year that not only do they have their biggest payday, but it's also the year they're going to have their biggest tax bill. And it's the year that they can make their largest contribution to charity to help mitigate some of those taxes. With the AMT rules that are coming up, proposed for January 1st, 2024, the advice is, if you're going to do a liquidity event, do it in 2023. If you're going to sell some appreciated securities and maybe put them, if you're not ready to give them away yet, and you just want to park them somewhere, set up a donor advised fund and deposit them there and take advantage of the full 0% inclusion on those donation of shares. Any clients who have done an estate freeze or will be doing an estate freeze, most people are aware that you can donate public appreciated securities, but most people are not aware of the fact that you can donate private company shares to charity. We'll hopefully get through an example of that. So anybody like that, anyone who has a tax bill due next April, and they're sitting there with a big non-registered portfolio of stocks, set up a parking lot of a donor advised fund today, deposit that money in, get the full market value receipt that you can use to mitigate taxes and pay no capital gains taxes. Do that, as I said, in 2023. Setting up a foundation or a donor advised fund is a great thing. We'll talk about that hopefully. Donating an existing life insurance policy that somebody no longer needs. We call it a policy preserver. Or if you have an estate tax bill on death, or you want to left a bequest in a will, these are all people that we can help to leverage or build up a more significant cost and tax effective gift.
Mark, just as a reminder, that donor advised fund, I know you use this all the time, and it's probably going to come up here somewhere, but useful thing, if you want to know more about donor advised funds, go to mycharityfund.ca, mycharityfund.ca, I believe.
Yep.
And lots to be had there, lots of information to help advisors help their clients. Advisors can do this. Again, all of this will help charities in the long run. So have a look at mycharityfund.ca. And if you want more information, I know Mark has some of that if you need it.
Perfect.
Mark?
Thank you so much. I'm so glad Marie Phillips asked a question and she wanted an example, and here she's going to get it. This is what I would like to see in every single client estate plan in Canada. We'll see the default of what they're doing currently, and then we'll talk about incorporating charity, or what we call a charitable bypass estate plan. Here's a 65-year-old couple. They're community leaders, $50 million net worth, mostly illiquid real estate, children, grandchildren. They'd like to figure out ways to minimize their taxes, and they have a very strong desire to maximize their legacy, especially if it can be done on a cost or tax effective way. Without any planning, it's not very pretty. They've got a $50 million estate. They're going to have $10 million of taxes because they've got some lower cost real estate, so lower cost based real estate. The family's going to get 40 million. Taxes going to get 10 million, charity gets zero because they haven't indicated anything in their plan to go ahead and do something around taxes. It's still not bad. $40 million. Look at, I'm an orphan. I'm available for adoption if anybody is, I'm always saying that. But now let's talk about an alternative. What we could do is we could use an insurance replacement policy that would cost pennies on the dollar, or again, in the right situations, could be done on a cash flow neutral basis, where instead we're going to have $20 million upon death go to a private foundation for this family or to a donor advised fund. That $20 million donation will create a $20 million charitable receipt, which would save the estate $10 million of tax. So at the end of the day, the family ends up with $50 million. The tax department gets zero, and we've created $20 million of charity. Now, I just want to point out here, those are the numbers. When it comes to AMT, the alternative minimum tax, I want everyone to be aware of the fact that there's no AMT on final estate taxes, no AMT. And not only that, but even though while you're alive, charitable donations can be used to mitigate up to 75% of your net taxable income every year, and any amount given over that 75% can be carried forward for up to 5 years. What most people are not aware of is on death, charitable donations can be used to mitigate 100% of estate taxes, and you can go back the prior year as well. And that's really the case here with Marie Phillips' question, where we're actually able to use charity for the right purposes.
Mark, if I could, I think to Marie's point, is there a resource to do this? And I know it would be nice to have a nice calculator to sort of slap it in and do these things. But I think as valuable is that example on those 2 slides that you've just done to the question that somebody asked also, will this be available on replay? Which means you can see this again, you can stop it, start it, do all that sort of thing, and you can recreate some of that for your own purposes so that you can tell that story. And that's as important as giving specific stuff, because if somebody buys the concept, then you can do the detail. The trick is to get it. And that example, Mark, is awesome. That estate bypass thing. Phenomenal.
Again, and it's so simple. All it takes really is, we work with a lot of advisors across the country, accountants, insurance advisors. Just share the information. In other words, yes, you can learn it yourself or develop somebody on your staff that can be the expert in that. And that's what we do. We train those people through our Power of Platinum to actually be, so that they can be that resource in-house. Or we do a lot of collaboration. So it's about having hyper specialists to help clients. Bring that information along. And ideally speaking, what we want to see is, once you've done the planning, the client sees what their tax bill will be here today and what their tax bill might be at life expectancy, based on a whole bunch of different assumptions. And that's kind of their default. What we want to do is we want to build in 5, 10, 15 different alternatives and measure those in terms of their ROI versus doing nothing. And also, how can they be used from a charitable point of view to create a legacy for the family? And it's a very, very powerful exercise, but it's something that requires the attention of the client and obviously the attention of the advisor who feels this is something that they want to do very special for their clients. But
Mark, I want to address one thing, because I know a lot of people will look at this and go, gosh, I'll never know all this. I could never be that smart. How would I ever learn all these things? Okay, you can get your your MFA,
MFAP.
MFA-P. You can get all, but I just won't pick this up. I'm 68 years old. I'm not going to do this. What would I do? I think the real key to all of this is that anyone on this call, and whether it's Mark or it's somebody else who is an expert at this, and I'm just going to play with Mark because Mark's my guy, but the point I'm making is, why would you want to learn it all if you could just use Mark as your legacy process consultant on a deal like this? have a shared arrangement on a case. You get half the money, Mark does all the work. Like, there's not a lot wrong with that concept. So I'm just going to refer everybody to you in this case, because it just makes sense. If I were an agent today, and I'm not, but if I were, there's no chance I'd be doing it, because it's just not my thing. But I'd love to have it done. And that's what you can do when you collaborate with advisors like you do all the time, Mark.
Thank you, Jim. Look, there are a lot of advisors who do what we do. I mean, there a lot. There are advisors that do this, and I think the key here is just having a bench, making sure that you have a good bench in place to be able to tap into when you need. But the most important thing is learn about it, collaborate, but don't ignore it. There's just too much riding on the line for our clients here in terms of what you could be doing to help them. And this is the type of conversation when you're having with clients that it makes them alive. It wakes them up. They feel this is something that I've been wanting to do and deal with, and nobody has really brought it to my attention. I've had many clients start to cry during this whole process. So why? Because it touches a deep part of our soul that I want to give back. I want to do more than just make money. I want to create a legacy for my children, and even more so for my grandchildren and great grandchildren. But here's on a very important slide, and we've already went through it about did you know? We talk about the tax, we talk about AMT, and one of the things that advisors don't know is that life insurance can be owned and paid for by a charity, by a private foundation, or by a donor advised fund. That means money that you move into a donor advised fund, which we'll talk about, that's sitting there. Yes, they have disbursement rules of 5%, but that money can be used to actually acquire insurance that's owned by your donor advised fund and paid for by that donor advised fund that will create even more charity for that individual donor. And by the way, I recommend that all advisors get in touch with your local community foundations, the Toronto Foundation, the Barrie Foundation, the Caledon Foundation, Canada Gives, Canada Helps, Benefaction, Abundance. There are so many great donor advised funds, mycharityfund.ca, and the Jewish Foundation of Greater Toronto. They all have donor advised funds, and just see how brilliant a donor advised fund can be. And it's something that nobody knows about. They just don't know about, and they don't know how to use it. And again,
Mark,
insurance can be used in those funds to create transformational charity. Yes, Jim.
I was just going to sorry, I keep interrupting you,
No,
but
please go ahead.
But that's what we do anyway. But the point I'm making is this: at the very beginning, you talk about what you do, but really what Mark does, and I just want to make sure this line gets said. It's not mine; it's Mark's. The line is this: we help convert taxes into charity. We convert taxes into charity, and there's a great line to get in to see a lot of people. Would you like to know how to convert taxes into charity? And that could open up a lot of doors. Mark,
beautiful, thank you. So just we talked about the sort of the psychology around insurance for the high net worth and the ultra high net worth. We talked about how it's a grudge purchase. It's not something that they really truly understand, which they don't in most cases. But where are the insurance needs for the high net worth? Well, they're the 6 cases on the bottom for estate taxes. Again, they don't necessarily need insurance. They have assets or that they can convert into cash, or they might have cash sitting around to pay those taxes. But insurance has to be looked at as, is it a better opportunity in terms of cost per dollar? Estate equalization, blended families today. Everyone's on second marriages. You have children in and from a first relationship, second relationship, kids in the business, kids out of the business. Insurance can be used for them as well to fund shareholders agreements, making sure that your partner is properly bought out. Their estate is bought out for their sweat labor, because you don't want to be partners with your late partner's wife and her lawyer or husband. Key person insurance. Insurance is an alternative asset using the CDA, the capital dividend account, to be able to get money out of corporations. And then the last area is philanthropy. Insurance is a great way. I kind of look at it, we finish in golf season, the difference between having a putter and a driver. A driver, that ball goes 350 yards, putter can go 50 yards. So, it's just a way of accelerating the way of giving at a very good cost. So what we want to do is just go through a few planning strategies, because it's 12:38 right now, and I want to be finished by 1 o'clock. And again, this exciting stuff. There's lots to talk about, but let's just go through some of these strategies and then we'll wrap it up in terms of what are the next steps and things you might want to do to help yourself and your clients. So we mentioned already private foundations versus donor advised funds. Private foundations can be set up. There's some setup costs, annual reporting, compliance, governance. You basically take care of your own investments within that as well. But it really is for people who are going to put away at least $1 million or $2 million into a charitable foundation. There are many foundations out there. You can go onto the CRA website and you can see everybody's private foundation. You can see exactly what they have in them, who's on their board, all the money they've made in terms of investments, disbursements. Private foundations are actually public. Okay, private foundations are public. A donor advised fund is you actually piggyback a community foundation, or in this case, like a Toronto foundation, or a Jewish foundation, or a Canada Gives, and you use their umbrella, their governance and compliance, and you put your named foundation underneath them. For that, there's very minimum fees. Generally, it's around 1%, or it's scaled based on how much money you have in it. You can often invest that money, meaning if you're a professional advisor, you can still manage your clients' assets under management. So you're not giving it up. You're actually just managing that for your clients as well. And generally, you have to have a disbursement of 5% per year of that money, although the money is professionally managed. So the idea is it should go up and you should never sort of eat into it, although you are allowed to have that money go in and go out if it's not restrictive money or restricted. But donor advised funds are actually private. Nobody has to know what you've got. So there are people who have private foundations who move their money to a donor advised fund. But then there are people who have donor advised funds move their money to a private foundation. It all depends. But one thing's for sure, as an advisor, I encourage you to get in touch with these organizations and learn about it. One idea that I think is really key here is what we call policy preserver. And that is, there's twofold. One is, I'll give you a real example that just happened with one of our advisors, Ruben Menzalewski. He met an individual who had a $300,000 permanent insurance policy that he bought many years ago that he no longer needed. As a matter of fact, he was offered by an insurance company to actually have that purchased by the insurance company to take that off their company liability, but he would receive money and it would be taxable money. So he said, is there something else he could do? So what Ruben did is he introduced that person to a charity that person was very enamored by. And instead he donated that $300,000 policy to that charity. He went ahead and he received a fair market value donation receipt. In this case, I think it was about $180,000 because he was no longer insurable. So that saves him about $90,000 of taxes. And going forward, the charity is actually going to be paying the premiums, which are only around $2,000 a year, in perpetuity for that donor who's in their 70s. The point is that the IRR is so big for the charity to only have to pay out $2,000 a year for a $300,000 gift. And this donor received a nice charitable receipt that offsets taxes, and he gets recognized for giving this tremendously important gift. And you just please be aware there's something called the 3-year and 10-year redeeming provisions. Make sure that when you do these strategies that they're done in a compliant way, because you want to get a fair market value as opposed to a cost-based value. Now, you might have clients right now in your book of business that have term insurance policies that most of the time they get too expensive and they get canceled, or the client doesn't need them anymore. Well, those term insurance policies can be converted at any time without any medical evidence at all. If your client is now aged or preferably is medically challenged, those policies have a tremendous amount of value in that you can convert them and actually donate them to charity on behalf of that individual. Again, it has to be navigated properly, but then suddenly as an advisor, you have an opportunity to create a sale through a conversion with no underwriting and create a whole bunch of money for charities that they would be something that would be of interest to the donor. So don't let those policies that you have on clients' books sort of get ignored. There's actually great opportunities there to leverage and create lots of charity. Jim, did you want to say anything?
No, I think you're you're on a roll now. It's all good.
Thank you. We mentioned already donation of public appreciated securities, but most people don't know about donating private company shares. I was just at a meeting with an accountant who did not know this. We were with a client of his, did a freeze. We're helping him understand it. But there are a lot of advisors here. And by the way, everything we have here, we have one pagers that are case studies for all of this. So if you reach out and send an email to Phil, Phil, Phil at WealthInsurance.com, he'll be very happy to share with you these one pagers to help you understand how this can work. But we had a family that did a freeze where the freeze value was $28 million. And they had a $7 million tax that was going to come out of those frozen shares. Again, they were going to do a wasting freeze over a number of years, but there was still going to be a tax bill. And they were philanthropic. So instead, what did we do? We took that $7 million tax and we turned it into a $14 million donation to charity using insurance, which brought the tax from $7 million down to $500,000. We created this $14 million gift. And the icing on the cake is we created a further $6 million CDA for the next generation. That means they can extract $6 million out of the company in the future tax-free, which saves the family an additional $3 million of tax. Again, just by moving all the shells around. Any of us have clients. Many of our high net worth clients are sitting there with large RSPs and RIFs. And first of all, they don't need them for their lifestyle. They've got other assets, and they're also not aware of the fact that it's going to be taxed at 53.5% in Ontario if they pull it out now or when they die. Well, maybe if they're philanthropic, they'd like to do something special with those RSPs or RIFs. And now they can. They could actually donate those RSPs or RIFs to a donor advised fund or to charity, any amounts or fully amounts, at a cost of around 3.5% versus at a cost of 53.53%. And there's a way to be able to get rid of the withholding tax of 30% for any withdrawals over $15,000 on those RSPs or RIFs. So now they've got this, let's say, $2 million at a cost of 3.5%. So it'll be less 3.5%. And now we could use those funds in a donor advised fund, possibly to buy insurance to actually leverage the gift to make it even larger. So again, RSPs, RIFs, great ways to create money for charity and for our clients where they don't actually have to write a check, utilizing something that they're not really paying attention to.
Mark, as I look at this, I talked before about leading edges of the wedge, and you look at most of these policy preserver, the donor advised funds, RSP, RIF tax converter, the CPP philanthropy, the GPS, any of those things are great leading edges of the wedge. And I want to, so that gets you in to have that discussion. So you need to know a little bit about that to do that. And that's really, look, most of the people, if not all of the advisors on this call, they know that if they can just get in, they will be awesome. They can make something happen. Trick is getting in. Those ways allow you to get in. And I think that's just a really, really valuable thing, that you can not only get in, help yourself, but of course, help charities as well.
Well, I remember, Jim, one of our Power Platinum members, you said they were having a challenging time getting in front of some of their higher net worth clients. And again, they couldn't get in the front door talking to them about life insurance or tax planning. But you mentioned to them, just ask them, would you be interested in converting taxes into charity and creating a legacy? Is that something you
Just,
and it just,
just the other day.
exactly.
Right
We're just
on.
talking about that. So again, we're in a language business. Having those words, having those discussions, having that passion can really help us. I'm not going to cover off everything here. I'd like to talk CPP philanthropy is good, and I want to talk about my per gift. But CPP philanthropy is, to me, just brilliant. Our clients who are over 65 are receiving CPP. Generally, they don't need the money. It's about $26,000 a year for a 65-year-old couple. Gets taxed, gets invested, it pays tax again and reinvested. It's kind of a novelty. I'm a pensioner now. How great. And people will wait till they're 70 till they start receiving it, but they have to realize when they die, it goes as well. It's finished. It's done. So alternatively, what we suggest is, if you're charitable, why not take that $26,000 a year and you could actually create a $1.5 million insurance gift as the premium is around $26,000 on a 65-year-old couple. If the charity owns the policy, then your CPP is considered a charitable donation. So you're not paying any tax on that. And you've created about a $1.5 million gift. If you have estate taxes, take the CPP. Don't get the tax break now, but donate the $1.5 million to charity when you die. That will create a charitable receipt that could save your estate $750,000 of taxes. Or take the CPP and let your children be the beneficiary of the $1.5 million policy and donate your RSPs or RIFs that would have been taxed at 53.5%. Well, the last one, which I love, we call it like the grandparent pension plan or the grandparent gift plan. What that is take the CPP, get the $1.5 million policy, but make your children, your grandchildren, the beneficiaries of that. Now they get $1.5 million, and if it's invested, let's just say at 5% a year, it's going to create $75,000 of cash in perpetuity for your grandchildren. And or maybe make it that fund goes to your grandchildren to give to charity to save taxes for them. But all it does is it helps to keep moving along the whole values and ethics and what you want to pass along to your kids, all by moving CPP. So,
Mark, I was just going to say that this just showing and proving just how, you've done all this thinking for people, and it's why that, using Mark as a strategic alliance, as to do joint work with him can be so valuable to you. All this work has been done. There are so many ways in and out to solve problems if you know somebody who knows. And of course, you're kind of like E.F. Hutton, I think, on this. When Mark talks, people listen. Mark?
Thank you, Jim. That's why we love helping advisors. And we love, a lot of advisors say, Mark, why do you give over your secret sauce? Like, why do you tell people all about this? Because I always say there's two ways to give. I can either write a check myself, or I can get other people to write checks, and I can create way more money that way and a lot more merit that way as well. So all I ask is we're happy to share all this information. If you're going to use it and do something with it, and you've had a success, please tell us of your wins. And potentially, why don't you join our $1 billion community and actually add to that $1 billion? But please tell us if it's working. That's what we'd like. The last one I just want to talk about is My Par Gift. Canada Life launched the very first life insurance policy in Canada for charities at the end of April. What's amazing about it, it's called My Par Gift. It's a one premium only policy. So you pay one premium only. And if you have this policy owned by charity, so it is owned by charity or it's owned by your own donor advised fund or private foundation, you get a charitable receipt for that one-time donation, which is a minimum of $10,000. Okay, $10,000, but we have people who have many millions of dollars that are going into these policies. So you get a charitable receipt for the donation, which means it's really costing you half based on that one donation, and you're saving taxes. And the result is you get a gift of anywhere between 8 to 20 times larger than the net cost of that donation in terms of a legacy gift vis-a-vis some insurance. So it's really wonderful. But the other part that, and actually I was involved with the design of this product over the last, I guess it's over 2 years ago that we started. But the other part that's really wonderful is everybody thinks when it comes to insurance, you can only get a benefit to charity when you die. But in fact, these policies have an opportunity to create a living benefit to charity. Why? Because they're permanent whole life insurance policies, and they create a dividend every year. And that dividend, instead of being used to buy paid up additions to increase the death benefit and the cash value, it can actually be paid out as a check every year. So that money can now go out to charity or to your donor advised fund every year. On top of that, the cash surrender value in these policies, which is owned by the charity as well. Normally, if you take money out of your cash surrender value, there'd be a deemed disposition. But because it's owned by charity, you could pull that money out and give it to charity today. So there's beautiful ways to do it. I would really recommend, as an insurance person, speak to your wholesaler, reach out to us. We'd be happy to talk to you about My Par Gift. We think it's a great product to have in the marketplace.
So Mark has to sort of see what happens. The guy
get excited.
He just overdoing. I think he's just having a stroke here. But anyway, it's not a problem. He's doing just fine. Mark, you feeling any better? I guess. Look, the bottom line to all of this is, if you see all the different angles, all the different ways of getting your client's attention. And that's what we need. If you want to cut through the noise, you want to cut through all the problems, and you do have to, whether you're talking about a high net worth, ultra high net worth, or just a mass affluent marketplace, unless you've got something to say that makes a difference, then you're going to have a problem. These ideas of Mark's that work, of course, we talk about in Power of Platinum, but even from right here, things you can use. Mark?
Yeah, let's wrap up. Thank you, Jim. Actually, here, well, I mentioned before, it's a sandwich: the emotional, the technical, which we've gone through, just a tiny little amount of ideas. We have over 20 different ideas or strategies to be way more generous than just giving cash checks and credit cards, which are the least cost and tax effective way of giving. But the emotional part, to wrap up, most of us know the names of our grandparents, but very few of us know the names of their great grandparents. Jim, do you know the names of your great grandparents? You don't.
I'm sorry.
Okay, so here's a picture of my great grandparents, Aaron and Liba Gross, back in Poland in 1934. Unfortunately, before they were killed in the Holocaust. Well, imagine if on January the 1st you received an envelope in the mail, and inside there was a check for $10,000 from your great grandfather, Jim. You think you'd remember his name? So,
Yeah, we always wonder about you think the family of John D. Rockefeller, remember who he is?
that's for sure. That's for sure.
Exactly.
So with philanthropy and incorporating this into your estate planning, you can always be remembered. They say that you live once and you die twice. I understand dying once, you stop breathing. When's the second time that you die twice? Is when people stop talking about you and they stop mentioning your name. We're living in very challenging times where a lot of our definitions of family, of traditions, are being very much disrupted. And the way to pass along those values, either through religion or through charity or through both. And philanthropy is really a way, and our older clients, our clients in their 60s and 70s and 80s, they understand this. So they really want to have this conversation. So what do we do in terms of next steps? Jim, you know, you're just some of the things what we've spoken about before. First of all, Jim, you also have a 48-hour rule, right? The
Oh yeah, well, mine's a bit different than yours, but
the idea here is, if something resonated with you today, you got one idea. Just think of one idea. Do something about it in the next 48 hours. Otherwise, it dissipates and it's forgotten. It's like having that coupon on the cork board that sort of gets, you know, papered over. Next, connect with me on LinkedIn. I'm always posting stories and opportunities and strategies. If you'd like, you can reach out to Phil at WealthInsurance.com. Get a copy of our tax letter digest. We've been writing since 2011, have about 150 publications on each of these ideas, and you can get the one pagers as well. Consider getting your MFAP, the Master Financial Advisor in Philanthropy, that was created by Knowledge Bureau, Spire Philanthropy, and the CAGP. And it's really a designation that's not difficult to get, but you'll be way ahead of the game. I'm actually on the faculty of the MFAP, and one of the segments in the course is from me. But invest in that, learn about it, or collaborate. Reach out to us. We'd love to work with you. And if you're working with charities right now, you should just know that they really don't have a big bench to help them with the planned legacy giving for their donors. Become that person. We're happy to work with you. We have a director of strategic philanthropy and planned giving, Cindy Himmelstein. You can reach out to her and she can help you understand how we can help you with the charities that you're working with. And also become an entrepreneurial philanthropic advisor. It's a beautiful thing. At least have it on your schedule of what you're talking to clients about. You can do it yourself, but don't ignore it, as I mentioned. And lastly, really, we're starting our next Power of Platinum cohort, and it's going to be starting in November 23rd. Where people are signing up already. If you go to the website, powerofplatinum.com, you can see some great testimonials there from great advisors. It's really meant for advisors sort of 10 years plus in the business, who are working in the or aspire to be in the high net worth marketplace. They're earning what maybe $250,000 a year. So they're settled, but they know they could achieve so much more. And they realize that philanthropy is a great thin edge of the wedge. They'd like to understand what I do, how I do it from soup to nuts, and have Jim basically, it's a once a month, 2 hour webinar like this where we're all together. And then there's 30 minutes of tactical coaching that Jim provides each person to scale their business with Mark's business, because we're not the same, but you can certainly get it to the place that you want to. We have a WhatsApp group that basically where we share, to keep the inspiration going throughout the month, and everybody's sharing wins, and I'm sharing stories, and Jim is as well. And then we also have these performance groups that we set people up in so that they can make commitments and sort of take the information they learn from each part of the month and put it into reality. It's a 12-month program. Again, the fees are deductible. It will take you a couple of weeks to get back whatever investment that you made, but it is a great investment. You'll hear about it at the testimonials there. Jim, what do you have anything to say about Power?
Yeah, just quickly about Power of Platinum. I think that's the most important part of this. Most of almost, I can't think of somebody who hasn't said this with regards to Power of Platinum. They get their investment back in the first month, and the second month, or third or fourth month, they do a collaboration. All of a sudden, everything's paid for two or three or 5 or 10 times over. So it's a huge thing. Remember, all of this philanthropy stuff really bases itself on, I think, what the 3 fears we all experience in the retirement red zone. 10 years before and 10 years after. And so those 3 fears are simple and easy to think about. And they're really everyone answered by these things that Mark has been talking about and that we talked about in Power of Platinum. What are they? Will my money last as long as I will? Will my life have meant anything? Will it have been significant? And will there be anything left over to leave to the people that I love? We solve all those problems all the time. And Mark does that with great elegance and ability in Power of Platinum, and of course at WealthInsurance.com. Mark, it's been a delight to be with you. Thank you very much.
Jim, thank you. It's great to partner with you on this, and I really appreciate all your input. And please go to powerofplatinum.com, reach out to me on LinkedIn, or send an email. You can always reach out, Mark at WealthInsurance.com. We'd love to help you in any way that we can. And together as a community, there's no reason why we shouldn't be creating at least $1 billion a year just by talking to the people that we care about who trust us in order to create legacies for their families in the most cost and tax effective way. So look out for our next LinkedIn Live. We have some great speakers coming up. Tim Sesnick with some end of year tax strategies. We've got Denise Castengay from Canada Gives, who's going to be speaking to us. We've got some great speakers, and it's all available on LinkedIn for you to see. But we look forward to having another Philanthropy Friday with you in a couple of weeks. And I just want to thank everybody for coming today and joining us. I hope you got a lot from the session today. Thank you again to Jim Ruta of AdvisorCraft. Really appreciate you joining us. Have a great weekend, everybody. All the best.
God bless.
Stay safe. Bye-bye.